Like many of you, when I first moved abroad, I was young and ambitious, but clueless. I was also a little disappointed because it felt like the connection I had with my country was severed, but also somewhat relieved due to the fact that I would not have to jump through hoops that filing taxes in India can often force you to. I mean, I was living in a different country, right? But then, out of nowhere, I got a notification from the Indian tax department. It turns out being an NRI doesn't necessarily mean you're free from tax obligations in India. In fact, there are a lot of things I didn't realize until I dug into it. Things that could have led to unnecessary tax liabilities if I wasn't careful. And if you are an NRI, you might be in the same boat. It's not an uncommon misconception that being an NRI means you no longer have any tax obligations back home. The Indian tax authorities continue to keep a close watch on your income, whether you're earning from India, holding investments, or maintaining a bank account. Hi, I'm Malvika, and in this video, we'll break down NRI tax obligations, exemptions, and how your income is taxed, helping you avoid common mistakes and stay compliant with Indian tax laws. To start with, there's one critical factor that determines your tax obligations in India: your residential status. So, how do you know if you're an NRI or a resident for tax purposes? To be classified as a resident of India for tax purposes, the criteria are based on the number of days you spend in India during a financial year, which is from April to March. Here are the main rules. If you stay in India for 182 days or more during the financial year, you are considered an Indian resident. If you have stayed in India for at least 60 days in the current financial year and a total of 365 days or more in the past 4 years, you will still be considered an Indian resident. However, this condition does not apply if you have been a resident of India for at least 9 out of the previous 10 years. You have spent at least 60 days in India in 4 of the previous 10 years. In simple terms, if you have been in India enough over the last few years, you will be counted as a resident. So if you don't meet either of these conditions, you're an NRI for tax purposes, and it's important to know that your tax obligations in India will be very different from that of residents. The first thing that you need to understand is what part of your income is actually taxable. Now, as an NRI, the income you're taxed on in India is only the income that originates within India. This means if you are earning abroad, like your salary or dividends from foreign investments, that income is not taxed in India. But if you have income that comes from India, such as rental income, capital gains from stocks or property, or interest from NRO accounts, then that is taxable in India. For example, if you own a property in India and earn rental income, that rental income is taxable here. Similarly, if you have invested in Indian stocks or mutual funds and made capital gains, those gains are also taxable in India. But here's the key point. Only the income that has its source in India is taxed. Let's talk about capital gains for a moment. If you are selling property, stocks, or mutual funds in India, the capital gains tax rates are the same for NRIs as they are for residents. However, if your income falls under certain exemptions, then there are deductions or exemptions that you can claim. For instance, if you sell a property and use the capital gains to buy another residential property, you can claim an exemption under Section 54. The next major hurdle NRIs face when it comes to taxes is TDS, or tax deducted at source. This means that anyone paying you money, whether it's a tenant paying rent, a company paying dividends, or a buyer purchasing property, is responsible for deducting tax from your payment before it even reaches you. This is great in the sense that the government gets the tax up front, but it also means that the TDS rate could be higher than what you actually owe in taxes. For instance, if you are selling a property in India, the buyer will deduct TDS at a flat rate of 20% on the entire sale value. Even though your actual tax liability might be much lower, the full amount of TDS will be deducted. Now here's where filing your income tax return comes into play. If excess tax has been deducted, which happens often, especially in the case of capital gains, you won't get that money back unless you file your ITR. This is crucial because you can claim a refund of that extra TDS that was deducted, and you'll need to do that by reporting the income in your income tax returns. Here's a pro tip. Even if your income is below the exemption limit, always file your ITR if you are an NRI. You may have TDS refunded to you, and it's a good way to stay compliant with Indian tax laws. Here's a list of TDS rates that you can pause the video to take a look at. While NRIs do face taxes on their income from Indian sources, there are some exemptions and benefits you should know about. For example, interest earned on NRI accounts is completely tax-free in India. This means that if you have deposited money in a non-resident external or NRI account, the interest earned on that amount is not subject to tax in India. However, this doesn't apply to everything. The interest you earn on NRO accounts, also known as accounts meant for income generated in India, like rent or dividends, is taxable. This brings us back to the important distinction. NRI accounts are tax-free, while NRO accounts are taxable. Another exemption you should be aware of is the capital gains exemption under Section 54. If you sell a residential property in India and use the capital gains to purchase another residential property within a certain time frame, 1 year before or 2 years after the sale, you can claim a full or partial exemption from capital gains tax. If you don't want to reinvest in property, you can also choose to invest in 54EC bonds, such as those issued by the NHAI or REC, and this can also help you save on capital gains tax. Another important money-saving mechanism could be through Section 115BAC. This section of the Income Tax Act introduced a new tax regime aimed at simplifying the filing process with lower tax rates across income slabs. This regime is especially beneficial for those who don't have many deductions to claim, as it reduces your overall tax liability. However, there's a catch. Under Section 115BAC, most of the popular deductions and exemptions such as HRA or home loan interest and Section 80C investments are no longer available. If you are someone who relies heavily on these exemptions, the old tax regime might still work better for you. But if you don't claim any deductions, Section 115BAC could be the way to go. To get into more of the details and see if Section 115BAC is the right option for you, check out my short video where I break it down even further. So what's the bottom line? As an NRI, you're definitely still subject to Indian taxes on income that originates from India. But you also have certain exemptions and benefits that can help you reduce your tax burden. The key is to stay informed, file your returns correctly, and claim refunds for any excess TDS that's been deducted. And if you are living in a country with a DTAA with India, make sure you're taking full advantage of that to avoid double taxation. At NRI Shala, we recognize the unique challenges that global Indians face. That's why we are releasing new videos every day tailored specifically for our community. Don't forget to subscribe and share with your fellow NRIs. Got questions or suggestions? Drop them in the comments and we'll address them in upcoming videos.